Hi, Ash. Welcome. Welcome.
Thank you.
Again, thank you so much for joining us tonight. We're about to get started on apartment one-on-one investing, where you're going to learn all you need to know to get started in apartment investing. As we're going along, if you have any questions, definitely feel free to drop them in the chat. And while we're talking about dropping in the chat, please drop in the chat where you're located. We love to know where everyone is located. All right, we have Washington, D.C., Maryland. I'm in Maryland too, DMV, Miami. Okay. Hi, Chris.
Texas.
Here. How you doing?
What's going on, Jesse?
Very nice.
Corona. What's going on, man?
Illinois. All right. Awesome. Well, I'll go ahead and introduce myself. My name is Tiffany Spann. I am the co-founder and partner of Crown Capital. I started off in the real estate space, in the single family space. And as I started building my single family portfolio, I was thinking to myself, I'll never be able to leave my day job building this way. So eventually I transitioned into multifamily. And that's where I could really see my vision and started moving forward and started building wealth. And that's where I also met my partners, Lupe and Noelle, here on the call. And I'd like to actually pass it over to Lupe so she can introduce herself. Lupe.
Hey, good evening, everybody. Thank you for coming. We are so excited about today's webinar. And one of the reasons is that we know there are so many people interested in real estate, but it's just a lot of information to process, right? And we want to be able to kind of share with you our journey and what we have learned so far. Like Tiffany, I also started in the single family, having my own rental properties and dealing with all kind of headaches with repairs, tenants, all that. So once I discovered multifamily investing and syndication, it's just a game changer. I am also an active duty military member. So I'm still serving, and I'm doing this on the side as a way to build wealth and build legacy for my family. So thank you all for coming, and we look forward to sharing with you tonight.
All right. I'm so excited for everybody to be here this evening. I'm Noel Parnell. I'm out of Philadelphia. I'm a former pro athlete, former scientist, full-time multi-family real estate investor, and we are wealth builders. And I'm pumped for you guys to be tonight. We have a great presentation. I hope you all enjoy it and ready for this. So I want to get excited. You got cameras, turn your cameras on. I want to see you. I like that excitement. I feed off that energy. So, if you got them, cameras on, I don't care what your kitchen looks like, anything like that. Let's see it.
Thanks, Noelle. And we'll go ahead and share out our presentation and get started. Lupe?
Okay, can everybody see my screen?
Yes, we can.
Yeah.
All right, welcome everybody. So we're gonna get started here. Let me see. So next slide. Okay. Okay, meet the team. Okay, we just did that. And again, thank you for coming tonight. So these are the topics we are going to cover. This is a very basic quick overview. We are not really going to depth on any of these topics, but I think it's gonna give you a good idea on how syndication works and some of the key phrases, terminology that you need to know, because when you look at an offering, these are the things you will see. And so we'll go over all that stuff and also look at a sample deal to show you how the numbers works and the calculations. All right, so let's get started. So what is real estate syndication? So basically, in a simple term, it is a group of people coming together and pool their resources together, right? So some investors bring their capital, operators bring their skill sets. That includes deal finding, financing, dealing with any property related issue, property management, overall business plan execution. So it's a group effort to manage a very large project. So that's what the real estate syndication is. And when it comes to type of property, really like any kind of property can be syndicated. So it could be a shopping mall, it could be an office building, industrial warehouse, multifamily apartments, which is what we do. And you might even see hotels, short-term rental, like high-end, that maybe in the millions, that can be syndicated. Usually it's gonna be a pretty large project, which requires, people to come together with their resources. And why do we do this, right? So in terms of, I think I skipped, did I skip a slide? Okay. And out of all these options, all the different property types you can syndicate, our preferred asset class is multifamily apartments. And why do we choose it? Basically, it comes down to a very simple reason. People will always need a place to live. There's a huge demand for housing in the US, like you already know. The housing is one of the most stable and recession-proof asset, because no matter what, people is gonna need a place to live, right? It is very low risk for the same reason, because people will always need a place to live. If you think about it, when it comes to recession, or if you have to cut things from your budget, right? What are the first things to go? Luxury items, right? Vacations, eating out, stop going to the restaurant. But you're never going to cut your rent payment or mortgage payment unless you absolutely have to. So this is one of the reasons why multifamily is a very stable asset, and it's just probably as secure as it gets when it comes to real estate investing. And also, if you have any money sitting in the bank account, as you already know, right? The money sitting in the bank account, especially savings account, it loses value every day because of inflation. In the stock market, it's kind of like you go with the market. It can be good, it can be bad, but you never know, right? You never know what tomorrow is gonna be. So it's kind of like riding the roller coaster, go with it. Now, real estate is a great investment vehicle, but I think with a lot of people, people love to invest in real estate, but they don't want to be landlords, right? Because you don't want to deal with tenant issues. You don't want to fix toilets. You don't want people calling you like at midnight saying their heater just went out. So how do you get all the benefits, but not having to deal with a headache? So this is where the syndication comes in. When you have, when you are part of the bigger project, and then it remove you from the day-to-day landlord duties. This is why another great benefit of investing in apartments. And we do want to point out the fact that it is a real estate investing syndication. It is an investment, and just like any other investment, it has its pros and cons and risks. And we're going to cover some of the key pros and cons in the following slides. So benefit, like from my personal experience, I think as an individual, right? Like say if you're gonna invest in a rental property, you might buy a rental house. We are all limited to how much money we can put into a project. Like nobody is gonna go out buy a $2 million, $4 million property just because, the type of constraint we have. So in apartment syndication, it allows investors to invest in high quality commercial institutional quality asset, meaning that Class A buildings or very large apartments. So you don't have to deal with like Section 8 or dealing with the tenant problems. It just make you have much better opportunities when it comes to asset classes. And another thing is, because it is a commercial operation, so there are professionals in everything we do when it comes to property management, contractors. So things are done in a way that is legal and efficient. So these are the great benefit of investing in syndication. And of course, another big thing is the tax benefit. Believe it or not, we talk to a lot of investors, and there are investors who investing just for the tax benefit because people need to have write-offs. And real estate offers what greatest tax benefit out of any investment compared to stock or any other thing that you may have experience with. Some of the examples are, one of the biggest one is, of course, depreciation. And then in terms of depreciation, there are different types. So the straight line depreciation is basically you take it over the course of the year, right? So for example, residential is 27.5 years, for commercial is 39 years. So you will depreciate like every year until the end of the max. But typically you don't hold your property for that long, right? Very rarely people will hold their rental properties for 27 years or 39 years. So this is where like some of this additional benefit comes in when it comes to syndication, because we offer cost segregation, which is an accelerated depreciation. It allows you to take very large depreciation in the first year to have huge tax benefit. And bonus depreciation is another, it's actually a policy that came into, I don't remember the year, but this year, well, no, 2022 was the last year that we are able to take 100% bonus depreciation. Now we are still gonna be able to do that in the next few years. So 2023 is gonna be 80% and 60%. So it's gonna go down by 20% each year for the next 4 or 5 years until it's zeroed out. But I guess there's a chance, there may be another policy that being implemented to offer additional depreciation. And some of the other thing is I want to talk about refinance, because a lot of times you are able to do a cash out refinance and pull the value out of your property, and basically that is a tax-free money. Mortgage interest is another write-off, and also on deferred taxes. This is talking about things like 1031 exchange. You are able to defer your appreciation, like buying trade up to a larger property. And we are going to have a dedicated session just on that topic, because it's a quite complicated process. But basically this is talking about 1031 when you trade up your properties and you're able to defer that tax. Inflation hedge. So it goes back to the way housing works, right? When the inflation goes up, and guess what? The rent goes up, right? So you kind of ride with the inflation. So we don't really concern. I mean, we do, but not as much as the real estate market does not lose value during inflation as much as the other asset. Essentially, it's gonna just ride it up. If it's a rise, it's gonna go up too. We talk about, so forced appreciation. So the biggest thing, the biggest difference between a residential property and a commercial property is the way they are valued. So I'm sure everybody is familiar with how residential property is valued, because basically, you know, like the value of your house is based on your neighbor's house, right? So if your neighbor's house is $200,000 and your house is maybe somewhere around there, you know, maybe a little bit more, a little bit less, but your house is never gonna be like 300 or 400. So the residential property, you are tied to the houses around you, right? So the biggest difference in commercial is that commercial property, it's really not valued based on comps. It's actually valued based on how much income it generates. And because of that, it allows you to have control. So for example, if you can increase the income of your building or decrease the expense, right? Either way, you're gonna end up with more cash in your pocket, then the value of your building goes up. And then some of the things we normally do, very standard in the syndication world, are we renovate the units and increase the rent. You can install water efficient faucet toilets to reduce water consumption and cost. Doing utility bill back to the tenant. And if you ever see vending machine, trash pickup, you know, they charge you $20 or $25 a month to pick up your trash, or $20 to park your car in the garage. All those things are to increase the value of the property. And of course, you know, just reduced expense is on the other side. So all these things that we are able to do to increase the value of the building. And another thing is about the passive income. So to have that monthly or quarterly distribution coming to you, to help you to build that passive income and replace the salary or your 9-to-5 job, and to eventually, you know, be financially free. And of course, like we already talked about, right? Real estate is also an investment, and investment all have risk. And here are some of the downside of syndication. And first is liquidity. So once you invested, your money is not liquid. So typically, you'll see this project last between 3 to 5 years, but sometimes it could be as long as 7 or 10 years. And very rarely the investors will be able to pull their capital out during this time. Of course, there are exceptions, but that is just not the norm. But so basically, once you're in for the long haul. Another thing is control. As a passive investor, passive investors do not really have the decision-making power. This includes any business decisions, any decisions related to the property, or voting power. So it really depends, right? If your goal is to be passive and not be involved, and it's great, but it may be uncomfortable for some. So this is just the way business works, and it's one of the way syndication works, because when you have a lot of investor in a deal or in a project, it's not possible for everybody to voice their opinion or have differences in opinion. And essentially, the operators are trusted to carry out those functions and carry out the business plan. And basically, you know, make sure the number hits the target at the end of the 5 years or 7 years. I'm going to turn over to Noel from here.
I was on mute, so I was already starting right there. But thank you, Lupe. So let's get into some key terms. So let's start with the general partner. The general partner is called the GP. Is the owner of a partnership who has unlimited liability. The GP is the responsible person for managing the entire asset. The general partner is also usually managing partner and the active day-to-day operator. The GP is also referred to as a sponsor or syndicator in a syndication. The next one we have is a key principal. So a KP are individuals that will basically sign on a loan or commercial loan as the guarantor. For example, if you find a building, any of you find a building out here that you love, whether it's commercial, multifamily, and you say, hey, I found this great building, it's in a great neighborhood, but the price tag on it is 30 million. So it's like maybe 200 units, $30 million. You may know that owner and have it under contract. When you go to a bank or to any of the agencies, Fannie or Freddie, they're going to say, what are you liquid? Are you liquid 30 million? What are your assets? They'll probably be like, good try right there, but maybe give it to these, I can give it to one of my other, borrowers here. So that is where a KP comes into play here, is that is the person that actually has the personal net worth to actually get that deal over the finish line and actually act as the personal guarantor. And one thing, if you didn't know, any loans over $1 million are normally non-recourse. So it's a little bit different from when you're in your small residential where it is recourse. So that means you're the personal guarantor on that. When you go over $1 million, those loans become non-recourse. The next one we have is limited partner. A limited partner is a partner whose liability is limited to the extent of the partner's share of ownership. In a syndication, the LP is the passive investor and funds a portion of the equity investment. So Lupe spoke about this a little bit earlier when she said, the LPs may have really no decision making. I like sometimes being in that LP position as we're in some deals as LPs, because it's a really great way to be passive. So that way, your money is still earning money while you're asleep. You don't have to, do the daily things as we do as GPs, where we have weekly meetings with property managers. I'm going down to Lubbock for one of our new buildings for a week. I love the building, but Lubbock, Texas isn't Vegas. So, while I'm excited about the building, it's not Vegas. So, but that's one of the things that I will do as a GP. But that's what a limited partner does. Next slide, Lupe. All right. So this part of the slides are real. I actually really enjoy, because this is where it's like, to me, this is the money slides. Who likes money in here? Raise your hand in the chat. Do anything right here. Come on, let's go. Yeah, I like it. I see you over there. Who's that? Ah, right. I love it. So I like to always say, if we have here your IR terms, your AR terms, your prefs, you may hear people pass them around interchangeably. They're throwing like, hey, we're giving, this pref and this multiple X, multiplier. What does that actually mean? And I want to talk to you, I guess, back it up for myself when I was actually in industry. I know how many people here are still working full time. You have W-2s. Good. Okay. How many of you contribute to your 401k and do the company match? How many of you have checked your 401k balance over the last, I would say if you're in your company more than 5 years, have you seen the trend, or have you actually seen in the last 2 years or the past year? How many of you actually been checking that and measuring what your money is doing, or even know where your money's invested at? Not many. So that's one of the key things that I love about multifamily is that it is a hard asset. You know where your money is. You're going to get reports. It's a physical thing where you can touch the building. We can actually bring you to the building if you want to see the building. You can smell it, smell the grass there, do whatever you want, But it's a tangible object that you can actually feel and track, and we keep you up abreast on that. But let me get you that down into the money situation, because again, our main thing here is to help build wealth. And the next thing is that we like to be comfortable, and we realize to be comfortable, we want to be rich. So if you want to be rich, come on, clap your hands right here, because I know I do. So, and that's my comfort level. So let's get into some of these terms. The IRR, internal rate of return. So the internal rate of return is the rate needed to convert the sum of all cash flow. That means regular cash flow, sales proceeds, principal pay down to equal the equity investment. The IRR is one of the main factors passive investors should focus on sometimes for a deal. I would like to speak to Crown Capital. We have a metric because we evaluate deals all the time. Our metric is that we don't actually touch anything or do a deal if the IRR is not at least a minimum of 18%. So, that's one thing you should know about us is that, guess what? We're looking at a minimum of 18%. So I want to bring it back now, because I know a lot of you had your 401ks, you max them out. Great. No problem with that. So historically, has anyone, actually looked at how the stock market has performed, versus, IRRs of multifamilies historically? But I'm gonna tell you, since 1950s, it's been around 7%. 7. Just think about that, 7% since the 1950s. Certainly some years there have been higher and some were lower, but 7%. In contrast, the average internal rate of return on multifamily properties have been between 16 and 18%. Just let that sink in. All right. The next thing we're going to go with right now is the ARR. The ARR is the annual average return, and it's really a formula used to measure the performance of an investment over a period of time. To calculate the ARR, you simply take the annual cash on cash returns for each year of the investment and average them. So that's basically what the average, the ARR is. So I want to bring it back again. How does that compare against the stock market? So again, the average stock market return over the 15 years has been around 7%. But after fees, inflation, and taxes, not to mention some of the nosedives, I know I'm getting killed on Tesla. Elon want to be tweeting and stuff. He needs to get back to that. So I'm getting killed. So I don't know about you guys. Those nosedives, they can go as low as 2.5%. On the other hand, multifamily syndicators routinely return an average annual return of 10%. This is across the board. We like to keep ours a little bit higher, but this is just across the board. I'm shooting it straight to you. The average annual return is about over 10% and above. That's compounded without volatility and after fees and after inflation, and yes, even after taxes. Remember, if you participate in the syndication, you get tax benefits. So we keep that in mind. So you may want to know, how does the ARR and IRR differ? Well, the internal rate of return takes into account the time value of money, or the understanding that you're going to reinvest your money to avoid losing value to inflation. So basically, that's the difference right there. I particularly in Crown, we like to really focus on IRR, and that's why we keep it at that 18% minimum there. Next we have, I think this page, preferred return. So a preferred return is simply a preferential order, a priority of payout for a particular class of investors based on the expected rate of return for that asset. So that's what we call it a pref in the industry, but that is a preferred rate of return. So as you see right here, we have that example. If the preferred return is 8% and you invest $100,000, the annual preferred return is $8,000. Does everybody understand that? Because guess what? We got a quiz. You weren't expecting that. Quiz time. Quiz time. Get out your pencils and everything here. So let's say you invest $100,000 into a real estate syndication, and the preferred return for the deal is 6%. What is your return? I'm gonna give you some Jeopardy music. How many? Put in the chat. Somebody put in the chat. What do you think that preferred return is? There it is, $6,000. There you go. There, get that man a mug right there. We have mugs, so get that man or woman a mug right there. Oh, mugs! Like now, I'm by Oprah. You get a mug. You get a mug. So here we are. Oh, now Pierre, you're a little too late right now. We're all out. All right, next slide, Lupe. We had the equity multiplier. So really, an equity multiple is defined as the total cash distributions received from an investment divided by the total equity invested. So we have another example here. Say you invested $100,000 and received a total of $200,000 in returns. So that's cash flow divided by cash flow plus appreciation calculates the equity multiple. Sorry, I couldn't say. I need my glasses on. So that would get you a 2x multiplier. Does everybody understand that? Because we have another quiz right now. All right. So say your total payout. Oh, hold on, Pierre. You understand that? Let's go back. Yeah, Pierre, I'm mute him. Tiffany, ask your question, Pierre. What don't you understand?
Can you repeat that? I'm in the car with the kids, so
Okay.
I can't quite hear you.
All right. So the equity multiplier is defined as the total cash distributions received from an investment divided by the total equity invested. So the example that we gave is that if you invest $100,000 and you receive $200,000, your equity multiplier is 2x. So that is you're dividing your $200,000 by $100,000 to get your equity multiple. And the quiz is, if you invested $1 million and you received a total of $2.5 million, what would be the equity multiplier? All right.
2.5x.
There you go. All right, we're on it. Great. So now we have cash on cash return. The cash on cash return is the rate of return on an annual basis of the total capital contribution that an investor has contributed to a deal. So for example, if you invested $100,000 and received $8,000 distribution each year, your cash on cash return would be 8%. So you know what I'm about to say now, right? Quiz time. All right. So if you invested $100,000 and you were receiving $10,000 a year, what would be your cash on cash return? All right, now we're cooking with grease. Now we're getting it. Good. All right. Next slide, Lupe. So here we go, is the equity split. So equity split is any profits from the asset according to the ownership percentage between the GP and the LP. Remember, the GP is general partner and the LP is a limited partner. Typically, what you see is a 80-20 split between the GPs and the LPs. That means as the LP, you will receive 80%, and the GPs get 20% for the roles and responsibilities. But wait, it gets better. If we have that equity split of 80-20 and we have the pref that we mentioned above, that means you get the pref payout and you still receive the 80% of that deal. This is why multifamily real estate is such a great passive wealth building tool. Any questions about the terms? All right.
All right, now we are going to put those terms into action and go over a sample deal. So we have a sample deal here, Sky Ridge Apartments. It was built in 1988. It's a 32-unit apartment, and it's located in a fast-growing market. It has a desirable unit mix of 2 and 3 bedrooms with washer and dryers in each unit. The minimum investment for this particular deal is $100,000 with a planned hold period of 7 years. And then there's also a refinance plan for year 2 to return approximately 60% of the investor's return. Next slide for me, Lupe. All right, so this is actually a breakdown of the investment returns here. So as you know, there's a minimum of $100,000. The cash on cash return is 8%. There's a GP-LP split of 30-70. The internal rate of return is 19%. The pref is 7%. We have an ARR of 18%. There's a refi in year 2, and the exit year is year 7. And the equity multiple is 2.2. So quiz time, guys, just to make sure we understood those terms we just went over. So if we are getting an 8% cash on cash return over with $100,000 investment, how much money would we make annually? There we go. Ash got it. 8,000. That's right. All right. He gets a second mug. All right. And I'll just ask one other question. If there's a 2.2 equity multiple for the opportunity and you've invested $100,000, how much money would you make on it? All right. Nice job, Pete, Andrew. Yes, 220K. That's right. All right. We'll go ahead and move on to the next slide. I think you guys got the terms down. All right. So many times when you're looking over a business plan or an offering memorandum to kind of look over the opportunity, you'll see this chart here that will show an example of an investment amount. And many times the amount is $100,000, and kind of the breakdown of the numbers on how you would actually expect your returns to come back to you. So here we just broke it down for the sample deal here. So in year 1, your returns would be $6,995. Year 2, a little over 7K. And then in year 2, there's also that refi. So you'd get a little over $60,000 returned back to you. And in year 3, you'll notice that your distribution is a little bit lower there because you do have less money left in the deal. Year 4, it actually creeps back up. You receive a little bit more. And then in year 5, a little bit more in year 6. And then in year 7, you get the big payout. That's when the property is sold. You get all of your capital returned to you. You also receive distributions that year, and then you receive the profit from the sale. And that's the thing that makes multifamily so powerful, is that you get percentage of the profit. And it's not an interest only type of thing. When you're in a syndication, you are part owner. So you actually get to reap the benefits of being an owner. Not only receiving the profits, but also those tax benefits that both Lupe and Noel spoke about earlier. I do want to pause right here to see if there are any questions on the sample deal up to this point. Feel free to unmute, or you can drop a question in the chat.
So I have a quick question. I've heard, that one of the, generally, so let me ask this. Who actually undertakes the underwriting? Who looks into what exactly is how are the numbers working out? Is it the key principal or one of the GPs or who?
Yes, so the GP team actually does the underwriting. And of course, the key principal, like we're all involved in the underwriting. And of course, when we take it to a commercial lender like Fannie or Freddie, I mean, our numbers have to make sense to them as well. So the general partners are the ones that underwrite the deals.
Thank you.
All right, so it looks like, okay, so Vandy has a question. What makes someone an accredited investor? Great question. We're actually going to go over that in the next, Lupe actually answered it, the next slides to come there. How do you calculate the estimated exit year? Okay, so in the business plan, we pretty much put together, we're going to renovate X number of units and raise the rents by this and decrease the expenses by X amount. And so based upon the business plan is how we determine the exit. We also look at what are the loan terms. We look at cash flow and just the return for our investors. If it makes more sense to hold an extra year or two, then that's what we would do. So it's not exactly one thing that we look at when we look at the exit year. We look at multiple things. We can look at deals sometimes and the exit year may be 3 years. Some of them may be 5 years, but the goal ultimately is to make sure that we are getting the highest return to our investors. So based upon that, we look at the exit. We determine the exit year. Now, we'll say this, let's just say in year 5, we've executed our business plan and we can return to our investors what we had estimated to return in year 7, we would go ahead and sell in year 5 so that we'd be able to return your capital along with the profit. So that way everyone could reinvest in something else and make their money, make more money. But essentially that's how we calculate the estimated exit year. Are there any other questions? They can. All right. On to the next slide. All right. So getting started here. What type of investor am I? So there's 2 types of investors. The first type is an accredited investor. Now, this is defined by the Security and Exchange Commission, the SEC. So in order to be an accredited investor, an individual income exceeding $200,000 or combined income with a spouse exceeding $300,000 in the past 2 years, and they would expect to receive that much income the same year or more, is an accredited investor. You can also have a net worth as an individual or joint with a spouse exceeding $1 million, and this would exclude your primary residency. And if you decide to invest as a business and you invest on behalf of your business, you have to have more than $5 million in assets, or all of the equity owners have to be accredited. And we'll just pause right there. It looks like there's another question here for Pierre. What are the min and max amounts that LPs can contribute? So typically, Pierre, the minimum investment is $50,000, but it is at the discretion of the general partners. The max amounts, we have an investor that wants to invest $8 million, and that's his minimum that he wants to invest. So when it comes to a max, it's not exactly a max amount for LPs. All right.
So I have a question on the net worth.
Okay.
Can that include one's 401k?
Yes, it can include your 401k.
Okay. And can that also include one's properties that one owns in outside the US?
Now that's a good question. I do not believe it would. Lupe, I know that you've owned properties internationally. Have you included that in your net worth when you went to validate?
So I do believe you can include that. So the only thing you cannot include is your the house you live in, right? Your primary
Okay.
residence. But
Okay.
the thing is, you have to be able to validate it. So there's a process that you go through, right? Usually your CPA can help you with it, or there are companies that will certify your accreditation status. So you have to be able to provide, you know, some type of documentation to show, like, okay, like whatever property in another country, what is the value of that?
Okay, thank you. So you're saying there are some CPA companies that actually work with you to check how you can get accredited.
Yes.
Yeah.
Okay.
With an offering, there's two ways that you can verify that you're accredited. You can actually have your CPA validate that you're accredited, or many times the offering will actually have a company that they work with where you'll go through them to validate that you are an accredited investor.
Thank you.
Definitely. All right. And the second investor type is a non-accredited investor. So that's anyone who does not meet the requirements of the previous slide there. So they don't have the net worth of $1 million, excluding their primary residence, or the income of $200,000 as an individual, or $300,000 as a spouse over the last 2 years. Next slide. So what investment options do I have? So there are 3 investment options, and we're going to go over those. Next slide. The first one being a 506B offering. So a 506B offering is actually an offering for non-accredited investors as well as accredited investors. In this offering, we can have an unlimited number of accredited investors, but only 35 non-accredited investors. Also, a 506B offering, you're actually not allowed to perform any sort of public solicitation. So we have a 506B offering right now, but we can't talk to everyone on this call about it because we haven't talked to everyone individually before. Some of you, of course, we've talked to and we have pre-existing relationships, but if we do not have a pre-existing relationship, we cannot actually share the offering with you. And Lupe, it looks like you stopped sharing your screen there. All right, so, oh, thank you. So as I was saying, if we don't have a pre-existing relationship with you, we actually can't share the 506B offerings that we have. And we cannot solicit it or market it on or advertise it on any sort of social media postings. And that's why a lot of times we do push people to actually schedule a call with us so that we can have a pre-existing relationship and start to develop that relationship and share with you our non-accredited deals. All right, next slide, Lupe. And then the next is a 506C offering. This offering can be publicly solicited and advertised as permitted on social media. You can run ads on it. And it's open to accredited investors only. And syndicators should always take reasonable steps to verify the prospective investors are accredited. And again, as Ash had asked, the way in which they're accredited is verified is that actually through their CPA or through a third-party company in which the offering provides. All right, next slide, please. There's also a joint venture. With joint ventures, these are most commonly used in smaller deals with investors. And typically the partners already have an established relationship. And in joint ventures, one key difference between a joint venture and a syndication is that all of the partners in a joint venture are actually active in the deal. There are no passive investors when it comes to joint ventures. 2 or more investors combine their resources, capital. Some people may have the capital, some people may have the time and resources. One person may be good on the construction side. Whatever the case may be, they come together to form a joint venture. And that's another way in which many people do purchase multifamily. And as partners, we have actually gone in on joint ventures together as well. One thing about joint ventures, they are not SEC regulated and there's no public offering for them. Do we have any questions regarding the 3 investment options there, the 506B, the 506C, and then the joint venture?
So
I have a question. Oh,
Okay.
go ahead.
oh, okay. So quick question for me is, for the joint ventures, do you have to create like an LLC and everyone be on the LLC to have that work?
Yes, you do have to have an LLC. There's also your partnership agreement, and we also have an attorney draw up the operating agreement and overlook all of the partnership documents.
And
Does
typically,
that-
how many partners? Oh, sorry.
Oh, I was just going to ask, Audrey, does that answer your question? Did you have anything else?
Yes. No, you're fine. I was about to type thank you in the chat. Thank you.
Perfect.
Yeah, I
And-
was wanting to know typically how many people are involved in joint ventures. Is it just 2 or is it like 20 or like roughly what? I mean, what?
Typically, there's not going to be any more than like 5 partners in a joint venture, but it's really deal specific, to be honest with you. Sometimes it's 2, sometimes it's 5, but I mean, the more active people involved, it may be a little harder to manage that deal. So there wouldn't be 20 people because 20 people would call for a syndication.
Thank you.
All right. Lupe, next slide, please. All right, so connecting with us. Here's all of our contact information. And we'll all drop our contact information in the chat as well. However, we do want to go over any sort of questions that you may have, and I'm actually going to turn it over to Noel.
Talking to myself again over here. Great. Thank you, Tiffany. Are there any questions from anyone? Open platform. Anything that's been, maybe in the back of your mind about, any hesitancy of investing or any question that you would like for us to answer?
Okay, so again, I'll ask the question. If anybody else has a question, please go ahead. Otherwise, I can ask one.
Sure, go ahead.
Okay, I'll go ahead. How does one become a general partner? What were the career paths that, so said, to be honest with you, I want to be where you folks are, like Lupe, Noel, and Tiffany, maybe in like 4 to 5 years. I'm 50 years old. I have a lot of work experience and a little bit in real estate, not a much. But very extremely analytical. So I think I'll be and very good with spreadsheets. I mean, I do research and so I think I'll be very good at underwriting. So that will be one of the value that I could bring in addition to significant capital.
Mm-hmm.
So how could I get to a situation where the 3 of you are today in like 4 to 5 years?
Well, I don't think you need, 4 to 5 years. We can, I think it's more, I think you already took the first step right now. I think if we can actually show you how we do it. So I know Lupe and Tiffany both put the calendars on there. You can schedule a call with us and we can show you how to become a GP. I think for myself, becoming a general partner is that I had a large portfolio in Philadelphia. I still own my things in Philadelphia. I was tired of going down to the studs, doing rehabilitations. I was also tired of the waiting period to get paid. So I would have to go, dealing with, several different contractors and subs in order to get paid. And so it was taking sometimes 8 to 12 months. the best thing right here that I love about syndications is that there's cash flowing immediately. So there's not a vacant building, it's always cash flowing, and we're doing value add. So we're always forcing the appreciation of the building by small aesthetic upgrades and or just rental increases. So I think you're on that right path, because I didn't, I was in science. I didn't hate my job. I actually like, love it. I love science, so that was one of the things. It became to a point where my portfolio really outweighed my income from science. And I was like, guess what? I don't have the time to manage both. And then I made the next transition to syndications and GPing, as I didn't want to take the time to rehab smaller items. It was just more efficient, because and time wise, it's just better. So it made sense.
Definitely. And I'll just piggyback off of what Noel said. Ash, if you're good at underwriting, then that's a strength that you can bring to the table. Because one thing, every deal that comes across, like, we have to underwrite it. And so after underwriting 100 deals, we may find 2 or 3 that actually makes the cut, so it takes a lot of due diligence in the beginning just to find a deal. And there's actually one question here in the chat from CJ here that I also want to comment on, because I know, Ash, you said that you'd be able to bring capital. So, being able to do those 2 things, that puts you in a position where you could become a GP a lot sooner than 4 to 5 years. Because another great thing with syndications is the partnerships, because the areas in which you may be weaker or maybe not have the time or may not be able to travel, your partners will be able to kind of pick up that slack. Because this is truly like a team and a partnership game. So CJ actually said, I have only invested in single family and duplexes. What do you feel were the biggest challenges transitioning to multi-units? So I'll speak for myself, and I can also pass it over to Noel and Lupe, but I think one of the biggest challenges is actually raising the capital. When we just closed on a $12.5 million asset, there's, over $6 million that needed to be raised. So having to actually raise all the money, that's a very big challenge. We're down to just a little bit more money to raise, and we were able to close the deals. But I would say that's one big challenge in itself. I think that the amount of effort it had taken me to build up my single family portfolios and smaller multis is the same amount of effort it actually takes on the larger side, because you are dealing with more professional property management companies that are giving you real-time reporting where you can log in to see what's going on. You're dealing with contractors who are just way more professional. And you're just dealing with people on a whole nother level. So it makes it a lot easier. You also have, your accountants and your attorneys, and people are picking up the slack in the areas that when I was building my single families and smaller multis, I was dealing with all of those things. I was the general contractor on site. I was the one, handling everything with the lending and just all the little fine details. Whereas this transition, you actually have professionals that you're able to hand over things to. And of course, you manage them. But in terms of the difficulty with it, I would say the biggest challenge for me personally would be the raising of the capital. But Lupe, what would you say?
I think definitely, you are only going to, we all reach our limitation, right? I don't care, maybe if you have $10 million in the bank right now, but at some point you're gonna reach your limit, you just cannot buy anymore and you cannot manage anymore, right? How many property do you think you can personally manage, and tenants, right, to deal with? I can tell you, from my story, I have 4 rentals. That's when I pretty much maxed out. I maxed out on the loan, on how much I can take out, because when the bank looks at your debt to income ratio, they just not gonna give you any more loan, because you just, you don't have the net worth to really back it up. I didn't have any more time to deal with contractors or tenants. I had all kind of issues, especially in the winter time, with the heaters and HVAC. So things like that, like we all gonna reach our limits. So multifamily allow you to scale, right? Allow you to leverage other people's resources, other people's capital to really scale. So that's the part, that's what makes it really powerful.
Yep. I agree. And I think for me, I think the hardest things, kind of what Tiffany said, the capital raising, but also is that quality over quantity. There's tons of deals out here, but they're not the best ones. And we're not only dealing with, your funds as a limited partner or a general partner. We have our own funds in those right there. We have, our mother's funds in there. You think I'm gonna let my mama lose? So no, we got to make sure this deal is great. These are retirements. These are people's SNAGs. These are their hopes and dreams. And I'm always taking into account for that. And we take that into account for every deal that we're doing. It's an individual behind it. It's a family. It's generations behind that. And I think that is so important to remember within the business. I know there's a lot going on within it, but those are things that keep me up at night, is making sure we're making the right decisions.
Hey,
Definitely.
Noah, I think you opened a good segue to the question here. I think that was Rafiu. Sorry, I don't speak your name correctly.
Oh, you're fine. It's good. Yeah,
He had a question. Do you want to go ahead and ask that question?
yeah. I was just asking, what's a good blueprint for kind of starting out with limited capital? Like because you guys are describing a lot of great points to the effect of someone being a general partnership, or perhaps having being the key. I forget what it was off the top of my head right now. I'm having a blank.
Key principle.
Our key principle, key sponsor, key principle.
And it sounds like being either one of those, it takes a lot of background experience to build and develop yourself, but then also leveraging support from other professionals that you bring into the group itself, that you can help and leverage their skills and knowledge in order to take some of the weight off of you and turn to accountability. So, but being that someone who doesn't know anything about that at all, like coming in just fresh and trying to build that concept of a syndication for their own in the future, if they wanted to branch off at any point, what would be a good blueprint? What would be a good starting point for them?
I think you did that. You started off right now. We do these weekly. So every week we're going to be dropping gems. We'll have weeks where we're going to be actually going over to underwriting and doing underwriting templates. We'll have other ones. We'll have, differences of, some key sponsors might be speaking, given their I guess lens on being a KP, or maybe have some limited partners speak. So you're in the right place right now, just always kind of tuning in here. And just remember, sometimes if you want to reach in, or if you're on LinkedIn, it takes nothing to drop a note, in somebody's thing and say, hey, what can I help with? Always add with some value. What can I help with? But I think you're in the right spot right now. Just tune in every week. We're going to keep giving you information. We believe in abundance. So we're not going to hold any information back. We get nothing from that, from holding any information back from you.
Definitely. And I'll also mention that if you have a limited capital starting out, the two things in order to really get a deal done is, one, you need the deal, and two, you need to be able to raise the money. So if you can do one or both of those things, then you'll be able to get into a deal. If you have the relationships with brokers or relationships with an owner that may own a property, it's worth, bringing to someone who you already know may be doing deals like us, or, someone else. Or if you have friends and family where you can raise $500,000 or $1 million, then that's another way for you to get your foot in the door to make money, as well as learn the process and really get started. So there's really a lot of ways to actually transition into being an active partner. But it's just, you know, utilizing your resources and thinking, what am I good at? Who do I know? And what can I bring to the table? And I will say it's like being consistent and like finding people that one will help, you know, to teach you what you need to know in order to be successful. And then two, just being consistent with it. Let's see here. There was actually one question that we missed, and it was, let's see, what would be the best way to have your deal sold with the large apartment deals without syndication? So honestly, Andrew, most large deals are actually done through syndication. Sometimes there's actually institutional investors that come in to help fund most of the deal, but they actually many times use general partners like us, and just they kind of act as the limited partner. And they may want some say so here or there, but for the most part, whenever you see anything large being bought, it's some sort of syndication or a potential institutional lender. Lupe or Noel, did you want to add to that?
No, I think you're spot on. You know, I think there's, to me, I always look at it as two buyers in the larger real estate. It's syndications, and then you have your big hedge fund guys. You know, Ray Dalio has big hedge funds that he buys real estate in, Blackstone, and then everybody else is syndicators like us. They're buying the things. So there's really two classes.
And we missed one other question here. What is the next venture you're looking at? So we are closing out an accredited deal, which is the Waterways portfolio. We did drop it in the chat. We also have a non-accredited deal for those of you who we have pre-existing relationships with. If you do want to know any of those, you know, non-accredited deals or joint ventures, we do have to have like a pre-existing relationship with you, and we're more than happy to share. Let's see.
Don't forget the Vicksburg deal. We have Vicksburg deal for unaccredited investors.
Yeah, but I mean, we'd have to actually have a relationship with them. Yeah. Oh, and it looks like that's all the questions. Noel, you want to close this out?
Yeah. So I want to, you know, I thank you for being here with us this evening, and also give yourself, like, clap yourself up right now, because you could have been anywhere. I'm sure you worked long hours. Clap for yourselves right here to sit through, you know, my antics. You know, I know you didn't come see me, you know, Tiffany, Lupe are the stars. So glad. But I wanted to end with, you know, if you want to see different results in, you know, 2023, you got to start doing things, you know, differently. You know, you have to think differently, surround yourself with different people to become the person you need to be successful. You know, and that goes into, what are you reading? What are you listening to? You know, who are you talking to on a daily basis? You know, tough times are already here, and you need to do everything in your power to protect yourself, or you're going to struggle for the next couple of years, if not decades. So I would say use the resources here for multifamily real estate. It's proven. You know, I had gone through a series with COVID where the pandemic was unprecedented. No one knew what was going on. Real estate had me stay afloat during the pandemic. If you actually just Google trends right there, the market and multifamily during the pandemic, who came out on top? It was real estate. So I'm just not blowing smoke up your wazoo, you know, that, but I just wanted to be, you know, completely honest and transparent. But I really appreciate you all being here, because you're already taking the first step right now, or you're continuing on your step to, listen, building wealth without Wall Street.
Hey, I just want to mention that for the two deals we mentioned this evening, Waterways for accredited, and then we have another deal that is non-accredited in Mississippi. If you are still looking for tax write-offs or depreciation for 2022, last year, you have a few more days to invest. I think the cutoff is next Tuesday, January 10th, to still getting for depreciation and tax write-off for 2022. So reach out to us if you want to discuss or more information on that.
All right, and Pierre, we're actually going to be sending out the recording to everyone who RSVP'd, so you'll actually get it tomorrow around noon. All right, well, thank you so much. Next week, we'll have another webinar, same time, Thursday at 7 p.m. We really appreciate you joining, and we look forward to building and growing and building wealth together. Have a great night. Bye.
Good night, everybody. Happy New Year.
Thank
Well,
you.
New
Thank you
Year.
for coming. Bye.
Thank you. Bye.
Bye.